Hi everyone. I'm going to lecture a bit on Chapter 13, which covers estate taxation. And I'm going to cover essentially the first half of the chapter, and then I'll do another video on the last half of the chapter. I thought it would be good for both me and you to maybe break it up a little bit. And there are some problems that are geared towards concepts covered in the first half, and then other problems that I've assigned you that are geared more towards concepts that are covered in the last half. So I recommend that you listen to this video and then do the, read through that part of the chapter and then tackle the homework for that. That covers that part of the chapter, and then you can listen to my second video after you've done the those couple of problems. So remember that I probably covered this back at when I lectured on corporate taxation, income taxation. Section 61 in the Internal Revenue Code covers the taxation of gross income, and essentially it imposes an income tax is imposed upon gross income, which is essentially defined as any sort of accession to wealth that an individual or a corporation possesses. Conversely, estate and gift taxes are part of a system that taxes the transfer of wealth rather than the income from that wealth. And there are some limitations to what kind of transfers would be subject to the estate tax. There are some floors that you have to know about, meaning if you're under the floor for the amount of the gross estate that's, or the net estate that's transferred, then you wouldn't be the decedent, or rather, the decedent's estate would not be subject to tax. So we'll go through that a little bit later. And this is covered on your first page, so you probably should just read through quickly, but there is a lot of history behind estate taxation and the changes in the law that have come about over the years. And Congress has gone back and forth. Where it's landed is that the tax rate now, the estate tax rate, is 40%. And that was beginning in years 2013 and thereafter. And the floor for taxation of a decedent's estate was indexed to 5 million. It's changed over the years, but now it's starting in years 2013 and after, it's indexed at 5 million. Now, what do we mean when we say indexed? When someone says the word indexed to you, you should know that that 5 million changes either from year to year, or it could change from month to month. In this case, it's indexed to 5 million starting in years prior to 2013, and then starting in 13, the floor becomes 5.25 million, then it goes up to 5.34 million in 2014, 5.43 million in 2015, and then for 2016 it's 5.45 million. In my text, and I hope they have this somewhere in your text, if you look at the back cover of the book, inside the back cover of the book, there are the tax rate schedules for 2016, both for corporations and estates and trusts. And you're going to have to refer to these tables when you do the problem. So I'm assuming that your book contains the unified credit amount as well as the estate tax rates, which are graduated, just like the corporate tax table is, graduated rates are applied. It's the same thing with regard to estate tax. So you are going to have to use the table. And as I said, in my book, it's in the back, inside of the back cover. By the way, the inside of my front cover has 2016 tax rate schedules for individuals. It's got the standard deduction amount, the personal and dependency exemptions, and the tax rate tables, as well as capital gains and dividend rates, etc. So it's quite handy if you need to refer to it either for yourself or for a client or for a friend or family member. So you are going to have to refer to that. I wanted to point that out to you. So as I said, estate taxes are transfer taxes, and they are assessed upon beneficiaries who are transferred property and money from a decedent's estate upon the owner of that property's death. So there's a formula for calculating the gross estate, and then which is actually referred to as the estate tax base. So for a corporation, you're taxed on corporate taxable income after application of NOLs and special deductions. And special deductions for a corporation are dividend received deductions. For an estate, you first start with the gross estate. And the definition of the gross estate includes essentially the same types of income items that you would think about in terms of an individual or a corporation. And essentially it's comprised of any property that's owned by the decedent at his or her date of death. And it also includes any property that the decedent doesn't currently own at the date of his death, but for which he still retains a right to the income associated with that property that he transferred. So for instance, if an individual before his date of death transfers over to his son an apartment building, and he says, you now own this apartment building, but until I die, I get all the rent income from it. And you go ahead and rent it out. I'm giving you this rental, this apartment building, but I get the rental income from it. And the reason an individual might do that, the father might do that, is because he needs that rent income to survive, to keep the roof over his head and food in his mouth, clothes on his back, etc. But he also wants his son to have something of his. And so he says, I'll give you the apartment building. Well, when he dies, that apartment building reverts back to his gross estate and is included in it. Then you deduct from the gross estate certain deductions. And we'll talk about those in a little more detail later, but it gives you a pictorial of what those would include. Expenses, administrative expenses of the estate, and also debt expenses, losses incurred, a marital deduction. There's a set marital deduction that the living spouse would receive and would be able to deduct from his spouse, his spouse who died. Also charitable contributions and state death tax deduction. All of those deductions are subtracted from the gross estate to arrive at the taxable estate. And so now we're down here. That's my dog squeaking on her toy. She's listening to me now, so now she's stopped. I hope I don't get bugged in a minute. Then you come over here to the right of the table and you add to the taxable estate all adjusted taxable gifts which were made after 1976. And 1976 is when there was a new law put in place. Before 1977, a decedent was able to transfer gifts and escape taxation of those gifts, so he could lower his estate and therefore not get taxed as much upon his death if he actually just took part of his estate during his life and gifted it to whomever, his children or whoever he wanted to, right? So they stopped that from happening starting in 1977. So they now make you add to your taxable estate the adjusted value of your taxable gifts, and it I think the slides are going to cover that. We'll talk about how that's calculated a little bit later. But you'll see down here that you get a credit for that. So then the taxable estate plus the adjusted post-1976 taxable gifts equals your estate tax base. And then what you do is you go to the table and you calculate your tentative tax that's owed on the estate tax base. Then you subtract from that tentative tax a number of things. You subtract the gift taxes that were paid on these gifts that you had to include in your taxable estate. So essentially you don't get taxed twice on them, but they want to make sure that you're getting taxed at the state rates. So they make sure that they include them up here, and then any tax that you paid on the gifts, you'll get a credit for those. So what you'll end up paying on the gifts is at the estate tax rates. You also get to subtract from your tentative tax the unified credit amount. And then there's a state death tax credit, which it tells you down here is for decedents dying before 2005. So that doesn't even apply anymore. You can ignore this unless I don't think I gave you any problems where someone died before 2005. But remember that there is a credit for that if I did. I don't think I did though. You also get a credit for any pre-1977 gift taxes that you paid, and a credit for taxes that were paid on prior transfers, and also a foreign death tax credit. And after you subtract all of those items from your tentative tax, that equals your estate tax that's payable. And you would file a estate tax return, you would calculate all of these items here, and then you would pay the tax when you file the return. So your gross estate includes all property that's owned by the individual on date of death. And it can either be owned by legal title or, as I said, it also includes certain property that you previously transferred but that you retain a right to, like that apartment building. It also includes dower or courtesy rights. Now, dower or courtesy rights are rights that certain states, if the married couple live in certain states, And I don't believe that California has dower or courtesy rights. I haven't looked it up though, but I don't think they do. But just know that in certain states, there is a law that says that a widow's interest in her deceased husband's property is get a certain interest in her deceased husband's property is accorded to her under, and it's called a dower right. And then if the wife dies first, the widower gets a courtesy right in a certain portion of the deceased spouse's property. And if you have that, if you live in a state where there are dower or courtesy rights, remember that the gross estate includes the dower or courtesy rights. So, in other words, even though the living spouse is accorded some interest in the decedent spouse's property that he leaves upon his death, that amount that's given to the wife, if it's the husband who dies, that amount is still included in the husband's estate. And then this last bullet just talks about the fact that probate estate is different than gross estate. So the gross estate is actually it's a tax concept. It's a concept that is defined in the code, whereas a probate estate is covered under state law. So the probate estate is essentially property that passes to the heirs subject to a will, or if they don't have a will, subject to state statute. And so if you've ever heard about the concept of someone dying intestate, that means that they died without a will, and state law will then govern who gets that decedent's property. And however, there are some kinds of property, even without a will, that escape inclusion in the probate estate. For instance, if there is a life insurance policy where that the decedent owned, where he named a beneficiary and the beneficiary was his daughter, and then he dies and the daughter gets proceeds from that life insurance policy. That life insurance policy is not included in the probate estate. So even if the decedent, the dad, dies intestate, i.e. without a will, that life insurance policy escapes probate. It's not included in the probate estate. However, the gross estate, what they're saying here is the gross estate usually encompasses or is the bigger subset of probate estate, if that makes sense. So here are a bunch of situations where property transferred to somebody else by the decedent before he dies is included in the decedent's gross estate upon his death. So the one we already talked about is where the decedent keeps an interest in the property. Well, it could either be an interest in the property or interest in the income from the property. So, for instance, down here in the left-hand corner, decedent retained economic benefit or enjoyment. That's covered under that apartment building example. Now, there might be a situation where the father says, son, I'll give you 50% interest right now in my apartment building, and I'll retain a 50% interest. And you get all the rent income from it because I love you and blah, blah, blah. but I'm going to retain a 50% interest in the building. Well, in that case, that's upper left-hand corner here. That transferred property, all 100% of it is going to be included in the gross estate. Joint owned property is included in the decedent's gross estate, and so forth. So all of these concepts are covered in the book, and you can read through them, and we might cover some of them in a little more detail as we go on here. But just remember, unless it's a free and clear transfer with no reversionary interest or no partial interest or no interest in the income from the transferred property, or if property is given away within 3 years of date of death of the decedent, the gift taxes on that property that was transferred over, because remember, if property is transferred over during someone's life, it's still you still have a transfer tax imposed upon that transfer. And what's that called? Those are called gift taxes. And there are different rules around gift taxes. That was in the chapter 12, which we're not covering. And maybe I should have, but we just don't have time in the semester to cover everything. But just remember, transfer taxes, there are two kinds of transfer taxes: gift taxes and estate taxes. So if the decedent, if the individual transferred during his lifetime some property of his, like to his son, he gives the apartment building, and he pays gift taxes on those, and then he dies 2 years later, so within the 3-year clawback period, he is now taxed on his gross estate includes the gift tax paid on that transfer. Okay? So in more detail now, we'll talk about gifts that are made within 3 years of death. So if the property is owned by the decedent and he gives it away within 3 years of his date of death, that property is included in the gross estate. And it includes the gift tax paid by the decedent within the 3 years of date of death, and that's known as the gross-up rule. So not only do they include the property owned by the decedent that was given away, but also the gift tax paid on that property that was owned by the decedent and given away within 3 years of his death. It also includes, so it does say here there's an exception. So policies that were originally purchased by the beneficiary but held by the decedent are not part of the gross estate, even if the decedent gifted the premiums. So you just have to know the facts of the life insurance policy and then go back to this rule to decide whether you're going to include some portion of that life insurance policy or the premiums in the gross estate of the decedent. Policies that are owned by the decedent and then transferred to someone else could be subject to inclusion, and there are rules around that. Now, there are other types of gifts that are also subject to the 3-year clawback. And when they refer to the clawback, they're referring to these first two bullets here where you end up having to claw back. In other words, those gifts that were made or those other types of transfers that were made within 3 years of the decedent's death, they are clawed back into the estate, into the gross estate calculation. And that's what they refer to when they say, that's what they mean when they say 3-year clawback. So any transfers where there is a retained interest during the life of the decedent, any transfers that take effect at death. So what they mean by that is a situation where you have the decedent before date of death has a reversionary interest. So if the property that's been transferred, if under the contract or the terms of the transfer, the transferor says that the other person receiving the property has to live longer than him. In other words, has to survive him in order to own the property. And the property, the value of the property upon the transferor's death is more than 5% of the value of the transferred property. Then, if those two rules apply, if those two conditions are met, then that's considered to be a reversionary interest. And in that case, the transferred property would be subject to the 3-year clawback, and it would be included in the gross estate of the decedent. And there's an example there, 13-20, that you can read about in your book, that gives a good example of what a reversionary interest would be. A revocable transfer is another kind of transfer that would be subject to the 3-year clawback. And that's a situation where at the date of the transferor's death, he has the power to change the terms of his interest in that property. So he can actually revoke the transfer and take back the property. He can change how much of the transfer is effective, and so forth. And in that situation, he has not given the property free and clear to a transferee. So in a situation where you've got a revocable transfer, where the transfer could be revoked in some way, then you are going to have a clawback apply. So if it's done, if the transfer is made within 3 years of the date of death, then it's going to be included in the transferor's gross estate upon death. Here's an example under section 2036, which is one of the 3 clawback provisions. And that's where the donor has the right to use of the property during his or her lifetime. The example is the mother can live in a house that during her lifetime, even though she gave legal title to her daughter. So in that case, the house has to be included in the mother's gross estate. Here's a situation, a reversionary interest situation. So Beth transfers an asset to Tammy with the stipulation that if Tammy dies before Beth, the property is returned to Beth's ownership and control. And that's essentially because Beth wants Tammy to have the property, but Beth doesn't want Tammy's beneficiaries to have the property. So Beth might say, look, I'll give you this property to enjoy during your lifetime, but if you die before I do, I want that property back. So if that's the case, then even if Beth dies before Tammy, the fair market value of the asset less the value of Tammy's life estate is included in Beth's gross estate. So that's the rule there. And then here's an example of a Section 2038 revocable transfer. So Joe funded a living trust where he could use any of the income or principal at his discretion. And then he named his son as beneficiary of any remaining amounts at Joe's death. So since Joe has the power to change the beneficiary and or use up the principal, oh, and by the way, that's not how you spell principal, where you're talking about principal of a trust. It's AL. Oh, that's weird. So since Joe has the power to change the beneficiary and or use up the principal and income of the trust, then Joe has to include the fair market value of the living trust in his gross estate. I just went and looked up the the spelling of principal because I was like, well, maybe I'm wrong. No, it's Princicipal, whereas the principles of what I'm trying to get across to you, that principle is LE. Okay, I'm sure you guys knew that, but apparently whoever made up these slides forgot about that rule. Now, the rule with regard to annuities is that if the annuity payments stop upon the death of the owner of the annuity, so an annuity is where you buy under contract the right to enjoy income either on a yearly or a monthly basis for a certain period of time at a certain rate of and it earns a certain rate of interest, and it can be a good way for a retiree to have income to live on without having to worry about the loss of income through fluctuations in interest rates, in the value of stocks and bonds. It's a little more conservative. It's much more conservative, actually, than investing in stocks and bonds. The price to pay is that you only earn at a certain rate of interest, which is fairly low. But like I said, it guarantees you for life or for the next 10 years or 20 years, there's all different kinds of annuities you could buy, a certain amount of income per month or per year. So if upon the death of the owner of the annuity, payments to him stop, then nothing is included in his gross estate. On the other hand, if the payments continue to the decedent's beneficiaries for some period after his date of death, then the cost of the contract, of the comparable contract, so in other words, whatever the cost of the contract would be to provide those annuity payments to his beneficiaries, that amount is included in the gross estate of the decedent. Now, you could have situations where you have property jointly owned by the decedent and either his spouse or someone other than his spouse. And we have to know how much, if any, of that property that's jointly owned we're going to include in the decedent's gross estate when the decedent dies. So the rule is that if the property is jointly owned with his spouse, then 50% of the fair market value of that property is included in the gross estate of the decedent. And if the property is jointly owned with someone other than his spouse, then the amount to include in the gross estate equals the fair market value of the property multiplied by the percent of the consideration to buy the property when he and his non-spouse first bought the property that was paid by the decedent. So the example they give, let's see if they give it here. They don't. But there is actually an example in the book where Fred and Jack bought some property together for $40,000, and Fred paid $10,000 for the property, and Jack paid $30,000 for the property. And then they were considered to be joint tenants with right of survivorship. So when Fred dies and is survived by Jack, the property at Fred's date of death was valued at $60,000. So Fred's gross estate would include $15,000, which is the $60,000 fair market value at Fred's date of death multiplied times his 25% interest in the property that's jointly owned by he and Jack. And the 25% is calculated as the percent of consideration paid by him as a ratio of the total consideration. So they paid in total $40K, but Fred paid $10K. So 10 over 40 is 25%. Now, general powers of appointment. I've actually decided that I'm not going to cover general powers of appointment in my lecture, and that's because it only covers a half a page. The rules are covered in a half a page of your chapter, and I actually have a problem on this. So I do want you guys to read through. It's fairly factual in how you determine whether property that's subject to a general power of appointment is includable in the decedent's gross estate. So you would just read through the facts of the problem to decide whether that property subject to the general power of appointment is going to be included in the gross estate of the decedent. As far as life insurance is concerned, if the estate is named as the beneficiary of the life insurance policy held by the decedent, then the life insurance proceeds are included in the gross estate. If the decedent owned policies on someone else's life, then the value of those policies is includable. And then remember that I talked before about the fact that your probate estate would not include the value of the life insurance policies or the proceeds. But there are cases like these where you are going to include the life insurance proceeds or the value of the actual policies in the gross estate versus the probate estate. I'm not going to cover this consideration offset concept. None of your problems cover it. And so I'm going to skip it. The QTIP trust is QTIP stands for Qualified Terminable Interest Property. And it's a situation where interest in property is transferred to one spouse, and it entitles the recipient spouse, the transferee spouse, to all of the income from the property for his or her life. And in that situation, the transferor can elect to take a marital deduction against his gross estate for the amounts transferred to his spouse under the QTIP. Or he can decide not to take the marital deduction. If he decides not to take the marital deduction, then the amounts going to the spouse under the QTIP trust are includable in the transferor/decedent's gross estate, and the recipient spouse, the transferee spouse, would not include the amounts transferred to him or her in his or her gross estate upon his or her death. These slides are kind of a tiny bit backwards. Now we're going to cover how to value the gross estate and the that part of the chapter is actually, at least in my book, is covered before everything that we just covered for the last 30 minutes or so. So the rule with regard to valuing the gross estate is that whatever the fair market value is of the gross estate, that's the value of the estate. Now you can actually elect to use the fair market value on the alternate valuation date. So before we get into what the alternate valuation date is, let's just talk about valuation. So with regard to valuation, you have to apply the value of the rules. You have to apply the value of the gross estate, which you're going to either use at the point of time of the date of death or 6 months later. You have to apply that to all of the property in the estate. You can't pick and choose and elect to apply to use the value at the alternate valuation date for some and the date of death value for others. It's got to be either all at the date of death, value all of it at the date of death, or value all of it at the alternate valuation date. You do use actuarial tables to value annuities, reversions, remainders, and limited term interests. So what is the alternative valuation date? It's the earlier of 6 months after the date of death or the date the property is disposed of or distributed. So obviously, if you dispose of the property in 5 months after the date of death, then you would have to, if you choose to use the alternative valuation date, you'd have to use the date on which the property is disposed of. And if you're disposing of your property at different periods of time, then it's going to be kind of hard to pinpoint what date you want to use for your alternative valuation date. Also, you can only use the alternative valuation date if it decreases both the value of the estate and the estate tax liability. You cannot use it if it merely increases your marital deduction. So keep that in mind. Now, we are now in the part of the book that I'm going to stop, and I'm going to let you guys tackle the part of the chapter that covers Objective 1, which is the estate tax formula. That was the first slide or two that we covered. And that covers like how to determine what the definition of adjusted taxable gifts is, your tentative tax on your estate tax base, how you determine that, your reduction in the gross estate for your post-1976 gift taxes, what the unified credit is, which just comes from a table, by the way. Then it goes on to talk about the gross estate, the valuation of a gross estate, and the rules around using the alternate valuation date. And then your book talks, and that's Objective 2, by the way, is the valuation of the gross estate. Objective 3 is where you cover the gross estate inclusions in the gross estate, which we talked, about, like the 3-year clawback rule. We talked about situations where you have dower or courtesy rights. You still have to include the amount of the rights accorded to the widow or widower in the decedent's gross estate. And then it also talked about the gross up rule, where if you gifts during someone's lifetime, if someone gifts somebody some property within 3 years of his date of death, then not only is the transferred property included in his gross estate, but also the gift tax paid is included in his gross estate, and that's called the gross up rule. And then we talked about the three kinds of transfers other than gifts within 3 years of date of death that are also subject to the clawback rule, and those are Section 2036 retained life estate transfers, which you can see the example in the book and also in these slides. Section 2037 reversionary interest, and there's a nice example in the book and also in these slides on that. And then Section 2038 revocable transfers, which has an example in the book and also in the slides. There's also a little discussion about annuities that we covered in the slides, and also jointly owned property that we talked about in the slides. And then it goes on for the next couple of pages on general powers of appointment, which I did not cover because we have a problem on it, and I want you guys to cover that yourselves. Life insurance, which you should read about, which is just a page. Consideration offset, which I don't think I'm covering at all in the problems. So I don't think you guys need to read about that, but you can if you want. It's a half a page. And then QTIP trusts, which are discussed topically at first in the book, and then they go into more detail later, and we will too in my second lecture video, because then we get into the portion of the chapter where it talks through deductions from the gross estate, and then computation, how you compute the tax liability on the estate tax base, and then credits against the estate tax that you were accorded, that we topically talked about in this first lecture. And then the last couple of pages talk about tax planning considerations, and also, which is interesting to read about, how you can, planning that you can do to lower a decedent's estate tax base, which includes gifting. And then also compliance and procedural considerations, like filing requirements, what the due date is, whether you are able to pay estate taxes. And that's it for this chapter. So my next lecture is going to cover the last half of this chapter, starting with Objective 4 on deductions. Okay, take care, you guys. Good luck.